My name is Danielle Guinter, and I'm a partner in the audit segment at McKonly Asbury, as well as the Director of ERISA Services. And with me today are Eric and Shalane. Do you guys want to introduce yourselves quickly?
Okay, name's Eric Blocher. I'm also a partner with McKonly Asbury and Director of the Business Valuation Services. I've been doing valuations for over 28 years.
Thanks, Eric. Shalane?
I'm Shalane Cohen. I'm a principal in our assurance group, and I've been with the firm for about 19 years, and most of those years I've been working on benefit plans.
Great. Okay. Now, for those of you who are not familiar with us, McKonly Asbury is a team of CPAs and business advisors that offer a range of services to various different industries, as you can see on the slide. We invite you to go to our website to learn more information. And then we can go to the next slide. Okay, so we're jumping right into the polling questions. If you wouldn't mind answering this, do you wish to receive CPE for attending today's webinar? If you are interested in receiving CPE or SHRM credit today, there will be 5 questions and you'll need to answer all 5 of them in order to receive your certificate in the next couple of weeks, which will come via email. Also, quick housekeeping item is if you have any questions at all during the webinar, please feel free to use the question function and we'll try to answer them as the webinar goes on. But if there's anything we don't get to, we'll answer them afterwards. And we'll just wait another second. Okay, great. Oh, so we do have a few people that are not here for CPE. Thanks for joining us. Okay, so as far as our agenda, Shalane and I are going to go through some best practices for overseeing your ESOP, and then we're going to turn it over to Eric, who's going to give you considerations when reviewing your ESOP's evaluation report. This is where you'll probably have a lot of questions. Shalane and I know had several questions for Eric as he was going through this. And then we're going to end up with some lessons learned from recent ERISA court cases.
So please ask questions.
Right, and moving on to polling question number 2. Are you a plan sponsor, service provider, or participant? We're just going to take a couple seconds for this as well. This is just really helpful for us to know who is in our audience. Just give it another couple seconds. Okay, so it looks like 24% plan sponsors, 56% participants, that's great, and 20% service providers. All right, thank you. Okay, so I'm going to kick things off. When we were going through best practices, the number one area we thought everyone should start with is understanding your plan document, because any issues you have with your plan is probably going to be driven from this. So typically what I recommend is maybe once a year do an inventory of all of your plan documents related to the ESOP. So that can be your actual plan document, your summary plan description, your trust document, your distribution policy, any loan documents if you're a leverage plan. And while you're going through them, make sure that they are signed. Sometimes in an audit, we'll request some type of plan document and we'll find that it's not executed. So when you're going through that inventory, make sure you have the actual signed documents, as well as any plan amendments. And then as you're going through them, make sure that the information in one is consistent with the other. So for instance, you have your plan document that notes all of your plan provisions and how the plan is going to operate. And then say you have your summary plan description that goes out to your plan participants. You don't want any differences between them. Like you don't want your plan document to say 1 year of eligibility and then your summary plan description say 6 months that you're giving to your plan participants. And then also it's a good time to verify that everything that's in your plan document is consistent with what you think, how you think the plan is being operated. So again, like just giving eligibility as an example, if you think it's 1 year, but you feel like people are entering into the plan in 6 months, that's something you want to revisit with your service provider. And it's actually a good idea to look at these plan documents with your service provider as well once a year, whether that be your ERISA attorney or your third-party administrator, because there might be some legal and regulatory language updates that need to be done that you might not be aware of, and they can really help you work through that, especially if you have an individually designed plan. And then Shalane, do you want to go talk about eligibility?
Yeah, and I feel like what I have to say about eligibility really ties in with understanding the plan document. So step one is really just making sure you understand the eligibility requirements. Some of the things that are nice to do, if possible, is with your eligibility. If you can have consistency between the ESOP plan, and a lot of times we see employers have a 401k plan, if those eligibility requirements can be lined up so that they're mostly consistent, with the exception of a few additional requirements that the ESOP might have. I think that's really helpful so that you have like a consistent starting base, and then you can just make tweaks to your ESOP one. Like, you really have to make sure for the ESOP, like a lot of times you have to be a participant at the end of the year, you can't be termed during the year, a year of service. So really combing through that and making sure you're identifying all of those participants that might not be eligible for the ESOP. And I think one of the big things, and as Danielle mentioned, working with your service provider is key, but there's a few different special rules for ESOPs. The one I think about all the time is the one for the former shareholders that sold their shares to the ESOP, like that they cannot receive those allocations. So I think that that's one thing really to make sure on the eligibility standpoint, is to make sure that they're not included as eligible for contributions during the year. And there are special rules, but work with your service provider on there. I think if you can at least identify those people and have them on like a trigger list to make sure you're reviewing those, I think that's really helpful.
Great. So the next item we wanted to talk about was allocations, and we'll go through the different type of allocations that we typically see on the next slide. But what we really want to talk about here is typically if there is an issue with allocations, it's because there's an issue with plan compensation. So it's really important to understand what your plan compensation, how it should be calculated based on your plan document. Typically what happens is I'm a plan sponsor and I'll run a report for my payroll system, usually your census, has gross wages, it has all of your deductions, and then you send it over to your third-party administrator who will calculate plan compensation and then do the allocations, which is completely fine. But as a plan sponsor, you are required to monitor those service providers. So it's a best practice to understand how they're doing those calculations. And usually what I'll recommend is to do like a sample test once you get those allocation reports back. You don't have to test everyone. Maybe you look at 10 people and you verify that the plan compensation is in compliance with the plan document. So a lot of times plan compensation won't include fringe benefits. So if you have a couple of people that you know have like a cell phone allowance, you can look at them and make sure that their gross wages is different from their plan comp, and the difference is that cell phone wage. Another easy trick is when you get those allocation reports, it usually will come with a participant activity report that'll list out everybody's activity through the year, throughout the year by participant. And a lot of times, like next to their name and their date of birth, it'll show gross compensation and plan compensation. So you can flip through that, and anywhere you see some differences, just pull up their payroll information and verify that you understand what those differences are. Because if the plan compensation isn't correct, the allocation isn't going to be correct as well. And then if you're really struggling and you're not sure, just have a call with your service provider and then ask them to walk through it with you with a couple of participants, which would probably help. And then we can go ahead to the next slide.
And I think, again, tied in with like the sample that Danielle was talking about, the approach that I recommend is reconciling your total plan comp to your year-to-date payroll report. And so like step one to me is identifying all of your different pay codes. And I think you can do this throughout the year, like as you add new pay codes, I think it's really important to have like a catalog of all those pay codes, whether they're included or excluded in your plan comp for purposes of your benefit plan. And then at year end, when you're looking at plan comp in totality, you can reconcile that and say, yeah, this is our gross comp. I'm going to back out all the plan benefits, bonuses, car allowance, like whatever it is that should not be included in your gross comp or in your plan comp. And to me, that's just like a great way of ensuring that you feel confident in the plan comp as a whole and individually without having to recalculate it in detail for every individual participant or recalculating what your service provider has done. So we recommend that to most of our plans. It's a good gut check at the end of the year.
Great. So we're going to go through a couple of allocation types here. This is not comprehensive, but just to give you an idea of what you can kind of look for. So, and I'm also going to try to do math in my head while I'm explaining this. So I'm sure Shalane and Eric will be more than happy to correct me if I don't get it correct. So the first one is cash contributions, and we'll make this pretty easy. So say you're a plan sponsor and you are going to contribute $10,000 to the plan this year to cover like distributions. So you contribute that $10,000. The way it's allocated to your plan participant is based on the ratio of their plan compensation to total plan compensation. So say I have 10% of total plan compensation, I would get $1,000 from that $10,000 cash contribution. Did I do that right, Eric? Okay. So forfeitures are going to be exactly the same way. So say you have 10,000 forfeited shares that need to go to the active participants in the plan. It's based on your percentage of plan comp to total plan comp. So again, 10,000 shares, I'm going to get 1,000 of those because I make up 10% of that total plan compensation.
You did good picking simple math.
Yeah, see, I was a little worried.
Good round numbers.
And then the next one is reallocated shares. And this one gets a little bit more complex. It's based on the same theory with the plan comp, but it's like a two-step process. So reallocated shares is someone takes a distribution from their account, and those shares are going to stay within the plan and be reallocated to the active participants. So what happens is the cash contribution is allocated like we were already talked about. And then that cash, based on the ratio of that participant's cash balance to total cash balance, that's how many reallocated shares they're going to get. So the cash goes into the participant's account and then leaves when they get the reallocated shares. So it's a two-step process. You do the cash contribution first, and then you do the reallocated shares. So this is the one where you really probably, if you're seeing any issues with that, that's the one you really want to be working through your third-party administrator, just so they can show you how it was calculated. Oh, and also, like, one note that we have at the bottom of the screen, not to be a downer, but if one person's allocation is wrong, everyone's allocation is wrong because of those ratios of total plan comp and total cash balance.
Which is why we harp on plan compensation, because you want to get it right so that you're not doing corrections to every single participant.
Correct.
Cash contributions for leverage plans. So with a lot of leverage plans, your employer is making a contribution to the ESOP so that the ESOP can then make their debt service payment to the plan sponsor. I was at a conference recently, and the one thing that they were harping on is that the IRS really wants to see that actual cash flow. So it should come out of the employer into the trust, and then from the trust back to the employer. I see this most of the time, but since it is typically just an in and out, I think that there could be the notion that, oh, well, why do I need to send it to the ESOP just for them to send it back? But that is something that the IRS is looking for. So just something to make sure you're doing that cash transaction.
The next item we want to talk about was distributions, and the first item is redeeming shares. So that basically means the shares are actually leaving the ESOP plan. And Shalane, you had just talked about that conference you had just gotten to, and you said this was a big focus as well.
It was a big focus, and I think a lot of it was making sure that the plan and the plan administrator and the trustee understands what's actually happening when those distributions happen. With the redeeming, there's kind of like two things that could happen. One, you could distribute the shares to the participant, and then the company could buy those shares from the participant. Option two would be the company or the plan sponsor purchases the shares from the ESOP, and then the ESOP distributes the cash to the participant. And the reason that's critical is because to understand the difference. In actuality, the participant's getting the same amount of cash either way. But where it becomes important is if the company is buying the shares from the ESOP rather than the participant, it's critical that in order to not trigger a prohibited transaction, that they're doing it based on adequate considerations. So you may need like an update to your valuation to make sure that the ESOP is not selling those shares for any amount less than their fair value or their adequate consideration. So you wouldn't need to do that if the company was buying the shares from the participants after those shares had been distributed. So it's an important distinction that I think everyone just needs to be on the same page with what's happening.
Yeah, Shalane, I might add, you might want to get an updated valuation, but I've never seen an ESOP that has wanted to pay for or to do an updated valuation because it's just more expensive to the ESOP.
Yep.
Now, the other distribution option we had already kind of touched upon. So that's where the shares stay within the plan and they are just reallocated to the active participants. And when we were preparing for this webinar, Eric made a great point about when you're talking about redeeming versus recycling, considering a purchase obligation study. Eric, did you want to talk a little bit about that?
Well, generally speaking, I think that you should, or ESOP should consider the repurchase obligation study, at some point during their life. The valuation industry is kind of split on how they handle that. There's no specific guidance out there. There can be people or waves of employees that are retiring in certain periods that could put some cash flow stress on the ESOP if there's a lot of retirements in one certain period. But you don't know that until you have a repurchase study done, and that should be done by an outside independent participant, that's in the business of doing those and understanding those. We'll look at actuarial tables and such that help do it. And then once you have that, then an evaluator can look at that and see if in fact it needs to be factored into the valuation, either as an additional cash flow liability or whether the company might have enough cash flow available to meet the liability through current operations that they have. And then using that can help make you a decision of whether you want to recycle versus redeem and all that. But you really don't know what's coming up until you have a study done. But they can be expensive and difficult. And certainly you don't want to update them all the time, although you may need to. These are all expenses of the ESOP that might be required or necessary, but not everyone wants to have them done.
Well, and then like one more thing that we didn't put in here would be like segregating cash accounts. So like the redeeming, when I think about the recycling, I think about that being you do that when the participant is taking a distribution. But if your plan document allows and it's set up that way, you can also decide that you want to do what's called segregating the account so that you're buying the shares of those terminated participants in theory so that they're not experiencing the increase in the value of the company. Instead, that's going to the participants who are still with the company and are still investing in making sure the company is doing well. So that's something we didn't put on here, but is also an option and really more of a timing thing. It's similar to the recycling, I think.
No, that's a great point. And then the last thing we just wanted to make mention, which is specific to ESOPs, is diversification. So because the majority, typically sometimes 100% of the investments in a participant's account in an ESOP is in that common stock, they are required, plan sponsors are required to allow for diversification distribution. So that happens after 10 years of participation in the plan, not 10 years of having a balance, 10 years of participation, and when you hit the age of 55. The plan is required to allow them to diversify 25% of the account balance over 5 years, and then in the 6th year, 50, that moves up to 50%. And typically the way that works is they'll actually roll over that 25% and then 50% over to their 401k. And we can go to next slide. Okay. Next polling question. Do you have a formal process for reviewing your valuation report? Yes, no, or NA. This is going to be a good segue into Eric's slides that are coming up.
I don't know that there is a good segue into valuation topics. At least that's what I've been told.
So we'll just give it a few more seconds. Okay. 22% said yes, 14% no, said no, and 65% said not applicable. And I guess that could be for the service providers, or maybe you're not sure if you're a participant.
Mm-hmm.
Okay, now here we go to the not so fun part of the presentation, ESOPs and valuation. First off, you gotta love it when I start off with a disclaimer. I write a lot of articles on valuation topics. You know, I have a lot of experience. I have my own opinions. However, as I say in all the articles, and I do get involved sometimes in litigation, that everything depends on facts and circumstances. So I want to say that the following slides are my own beliefs based upon my experience over 28 years in the valuation profession. In any instance, the unique facts and circumstances of each ESOP should be considered in every valuation, and you may cause an appropriate answer for your ESOP or your facts and circumstances to be different than what I said here or recommended. You know, you have to look at it that way. And it also prevents, if I ever get into litigation in the future and someone says, well, in this ESOP webinar you did 10 years ago, you suggested this. I said, aha, but did you read my disclaimer slide where I said different facts and circumstances can arrive at different answers? It'll allow me to get there. So with that, I think I did the CYA enough with the above. So if I have, then let's have at it. And please ask questions, send them in. If anyone that knows me or has been around me knows I love talking about valuation. Fortunately, I think my clients appreciate it. Some people that I work with might not so much, but hey, you're here for a webinar, so ask away. First off, and this is something that everyone should be aware of, and it's something that I don't see, or I don't know if everyone is, and that's, you know, a company that's owned by an ESOP. It's different than other companies in that, you know, it's an employee-owned, business, but it also isn't different. And what I mean by that, the value of a company owned by an ESOP can and should go down at certain times, just as any other business would. If your industry all of a sudden suffers or falls off a cliff, the value of your company should go down, and could go down, as it would for, a company that's operating in your industry that's not an ESOP. Values would decline. It can also take off tremendously if something happens. If we think back to the COVID times, companies that were in the food industry, when people started hoarding food, and all of them, you couldn't find food, or if you owned a company that made toilet paper, your value skyrocketed for a little bit. And an ESOP company could go up like that, just like any other company. So industry factors can come into play where values can increase, and that's a good thing for participants, but they can also go down. My experience working with Danielle and Shalane is I get to review a lot of valuations for ESOPs that they do the audit of. And, when I've been doing this for 15, 20 years, I've seen some valuation reports that, over time, it appears that the evaluators believe that the ESOP value or the company's value should always be going up over time. So that makes things easy. And that's not always the truth. It shouldn't. Economic factors such as increasing interest rates, which we've seen a lot of lately, decreasing net income, because inflation, costs like that, or decreasing cash flow can and should result in a decrease in value. So that's something to keep in mind when you're looking at your valuation. And then to paint a picture, there's other factors that can come into play. Now, if we look at the value of your company as like a big piece of pie like this, it can be split up into, it's financed by equity and debt. So the value of your whole company can be split up into those two pieces, the debt portion of it and the equity portion of it. And if your company has a significant project or capital or something where from year to year the debt significantly increases, the value of your company may not change. The pie size doesn't change, but the slice that is the equity portion can shrink because the debt portion got bigger. That's another reason, an example why the value of your company can change over time. I've also been involved in evaluation, doing evaluation for the first year after a transaction of a company. And the transaction for the initial ESOP purchase was done, and the company didn't have any long-term debt prior to that. And immediately afterwards, the long-term debt that was financed by, they had tremendous amount of debt. So the pie beforehand was all equity, so it had a big value to the stock. But then immediately after the ESOP transaction, the value of the stock was about this big because the most of it was debt. And that's something to be thinking about when you're an ESOP company, is that over time, if you are a leveraged ESOP, your value will go up naturally as you pay off the debt. And that's good because an ESOP is a long-term retirement benefit to the participants. And that's one way that you should be thinking about things. The next bullet point is that the assumptions used in valuations should be consistent with sound economic and valuation theory and not used to support a desired value or value trend, i.e. increasing each year. You really need to take a step back and if you're reviewing your valuation or the evaluator, now the evaluator should be doing this, and they should be an advocate for their own opinion, not an advocate for the ESOP, because they're not hired to support the ESOP. They need to be an independent evaluator that should be an advocate for their own team. They should be, or their own opinion, and they should be looking at this. What factors sound economic valuation theory? What I did the last couple of years, if you go back 2 or 3 years ago when interest rates were really low, when they started to creep up, I had a discussion with all of my clients saying, hey, there are things that are out of your control that will impact value. And one of them is an increase in interest rates. All things being equal, if interest rates go up, values go down because your cost of equity and your cost of debt is increasing. So those are factors and economic factors that are outside of your control that have an impact on value. And so they need to have a sound economic and theory on that going into the expectations about their valuation. So I'm kind of saying that here you really need to have a grasp of sound economic and valuation principles to understand why it won't go up every year or go down every year. And then if assumptions in your valuation change from year to year, I believe that those changes should be explained in the valuation. Certainly that I think that goes a long way to telling the story of the valuation and what changed with the company and why things happen. And to me, I think that's one of the most important things that you can be doing, or evaluators should be doing, is telling all about the company, but then what changed and why from year to year, so that if you're overseeing your valuation, you'll understand the hows and whys things change. Any comments on that, Shalane or Danielle?
Eric, I wanted to ask you a question, and I feel like I've seen this where the ESOP purchases shares from the former shareholders at, let's say, $200, and then the first year of the valuation after the ESOP is an owner, that price drops pretty significantly. And I think that makes sense, and I want to make sure.
That's the debt portion of it. If you think about, if you buy a company that has no debt for, okay, let's just say $1 million, and then now you have a loan for, you had $100,000 in cash, and then you have a loan for $900,000. The equity portion of it's going to be that 10 or that 100,000, and the debt's going to be $9 million or $900,000 there. It's the portion of it's the day before and the day after the transaction. The overall size of the pie hasn't changed, so it's still worth the $1 million, but the slices are different. Before it was all equity, so it's the person who's selling it gets the whole value because they own the equity. After that, then the participants or the equity value is real small because they got to get the debt. And as you pay the debt off, the slice of the equity pie gets bigger and the slice of the debt piece gets smaller.
Well, and I think that's such an important part to educate the participants on that, like, because I'm sure everyone who gets this, who sees that huge decline might do a slight panic attack or like question what's going on. So I think that's,
I can tell you, it's not fun to be the evaluator on a first year ESOP after that was highly levered, and they were never told that the price per share would drop drastically. So I had to go through the whole educational process and explain why. I mean, fortunately, there's literature out there and you know, where I could do it, but it made sense. But you know, they were never told, hey, expect the prices are going to be different. The transaction price is not going to be anywhere near what the stock price is after a leveraged transaction. Okay, one of the trends that I'm seeing is a schedule. And this is good practice. I'm trying to work it in, you know, my ESOP valuations going forward. But it's a schedule showing the change from the prior valuation from a dollar and or percentage perspective for information used, such as the change in the cost of debt, either an increase or a decrease. If the cost of debt increases, it would make sense that then your required rate of return increases and values could go down. If it decreases, it could cause an increase in value. The same thing with the change in the cost of equity, the change between the years. And you can see then by looking at these things, like the change in the risk-free rate, that's part of the build-up of the cost of capital and in your cost of equity in there. And you know, interest-free, the risk-free rate typically in valuation is a 20% or 20-year bond rate, and those were very low for years under COVID and everything. And all of a sudden, now they're a lot higher than it would be. But that's an increase in the cost of capital and a decrease in value. They should be showing the change in the weighted average cost of capital, debt and equity percentage assumptions. Now, what you do is typically you value a company, what's is called net of debt, which is you don't look at interest rates and you subtract off the debt from the value, and you look at the invested value company, invested capital value of the company, which is both debt and equity, and you use a discount rate or a weighted average cost of capital that considers the debt and equity costs in there. So you should also be disclosing the assumptions and the changes in the debt and equity percentages each year. Like, you know, ideally, if the industry hasn't changed much, the company hasn't changed much, those percentage assumptions should remain stable, or if they change, you should explain why they're changing. The change in EBITDA multiple is used. And an EBITDA multiple is used sometimes when they're using the guideline public company method or an income approach. And if the assumptions for the multiples have changed, then you should explain why they've changed and how they've changed. The change in the total fair market value and the share price for each method too. Typically, you know, the income and market approaches are used where it can show how much things changed. And you know, you can also have information here like, you know, your top line revenue was this, top line revenue for last year was this, operating income was this during a year, operating income was this during last year. And by doing that, you can see what the trends are and can get you give you a feel for where valuations or the value of the company can and should go, you know, based on these. But it's information that's, you know, put together in one schedule, typically in the back, or in one of the first things that you do is that here's the value and here's how everything changed, and it can set up the rest of the report so you can get a better understanding of it.
It seems like this would be very helpful to someone at the plan sponsor who is reviewing the valuation. Would it make sense for them, if they're not seeing the schedule in the valuation report, for them to request it?
I think it would. Now, some of the reason why it's not in mine is I review in detail the draft reports with my clients, make sure they understand that they don't have any questions. So that's why the report or the schedule doesn't sometimes make it into my reports, but I'm starting to think I want to move it in there because they can forget the conversation. And this would be a good reminder, you know, as to some of the things that have changed. But that's why I don't have it all in mind, because I review the draft in detail with them to make sure there's no questions about things. But ideally, yeah, I think it would be a good idea to have this. It can't hurt. It shows the documentation, and if something doesn't make sense between those, like, okay, here, if your cost of equity has gone way up, or cost of debt has changed from year to year drastically, but the value hasn't changed, and something else is different, you know, it might be off there. So if you look at the changes in the way that these are going, it can help align with where the value is going to and see if things make sense. Next slide, please. Okay, the trustee for the ESOP, and this I think is best practice, they should be reviewing the annual draft valuation. And when I say draft valuation, because you as the trustee should have some input in this. I mean, you have to approve it. Don't be afraid to question things. I like it when I'm questioning on things, just because it gives me an opportunity to explain the hows and whys that I'm doing something, so they better understand the process. Or I might have had a misunderstanding about something. I may have had facts or circumstances wrong. So when I'm questioning, it causes me to go back and look and see if I had my understanding correct. And that's why I think trustees really should be looking at the draft and not be afraid, to ask questions. Best practices suggest that trustees for the ESOP should be an independent outside trustee. Now, I know it doesn't happen all the time, but by best practice, what I'm saying for that is, this can assist the trustee truly being a fiduciary for the ESOP without any potential conflicts of interest. Because what happens if the ESOP's not a controlling interest? It's not 100%, if it's like a 40% interest, then you still have the owners that might be trying to pressure somehow the trustee to accept a certain thing or not challenge a valuation because it would impact them as well. But an independent trustee should be a little bit removed from pressures that might be there with the company. And an independent trustee often, they have experience reviewing business valuations, and they might be more apt to challenge assumptions or obtain clarity when needed. So I think that's a best practice.
Eric, we did have a question come in. Are there significant changes in methodology between a valuation that is performed for ESOP purposes and a valuation that is performed to market the company to potential buyers?
Yes, to some degree there is. Some of these I'll go over in the next couple of slides, but like I said before, it's similar to other companies because they still are subject to all of the industry impacts and pressures, but there are nuances that you need to factor in. Some of the things that come into play for an ESOP valuation might be the repurchase liability. Mm-hmm. They also have the financial statements where you might have the non-cash ESOP compensation expense that you have to factor in. And then if you're removing that from a controlling ESOP, then a normal operating business would typically have employee benefits expense that you would have to add back in. So there are some normalization adjustments that you should consider for ESOPs, and this isn't going to cover everything. But methodology, I'd say it is a little bit different to some degree. That's just part of it. The second part of it, I'll touch base on a little bit more when it comes to taxes and things like that. But then also there is a big difference in the marketability discounts of an ongoing outside fair market value valuation and an ESOP valuation, because the ESOP has a put option in there. And the put option drastically reduces the marketability expense because there's a built-in market for the shares. Now, how much it reduces it by should be, you should factor in whether the company can meet its repurchase obligations or not, whether you think they have enough cash, the profitability of it. All these factors come into play that with what you reduce your marketability discount by because of the put option versus a company that would not have a put option. So that's some of the nuances. There are other factors in. Some valuators, they have an amortization tax benefit factored into an initial valuation, and it is the deductibility of the principal payments basically for the ESOP loan is like a tax benefit with that. Some people and some valuators include that in value. If it started that way, you need to continue doing it that way. There's an argument to be made also to some degree that you don't start doing it that way. I've seen valuations done both ways, but those are just some of the differences between them. And then, there's a little bit more risk to some degree because the Department of Labor is looking over your shoulder versus another company that might not have the regulatory issues. All of those things come into play. And some things I'll talk about in the next couple slides, that are just make things different. Okay, another question. How should an owner who's considering an exit think about the side-by-side comparison of the ESOP valuation versus the valuation for planning a sale of the business? And that's a good question. And now here's my own opinion, and because I've just seen this very recently. I think one of the considerations that would be coming into play is what the owner wants. If the owner is looking for top dollar for their company and not potentially the impact on the remaining employees, then an ESOP might not be the best answer, because ESOP is required to pay no more than adequate consideration, which is estimated fair market value for the company, whereby an investor or private equity or venture capital, they may come in and value it and pay on an investment value, which is higher than fair market value because it looks at synergies, other things, and they could pay more. So an owner can get more money by going elsewhere other than ESOP. However, there's some downsides to that, at least in my experience. Venture capitalists and private equity, they're going to get the return out of the company regardless, somehow. Sometimes it's letting employees go, and it might not be as good of workspace for the remaining employees as it would be otherwise. Now, an ESOP's a little bit different. You may not get as much, on the actual transaction. You may or may not, but you also, I think, have an opportunity for the remaining people that are employees of the company to have a benefit that they wouldn't have elsewhere. And there are some potentially powerful tools for an ESOP. And one of the things that I'll mention before, if you're an S corporation that's 100% owned ESOP, there's a chance that you could be a non-taxable entity then. You have to pass certain tests, but what that means is you don't pay income taxes, and the money you save from not having to pay income taxes can be used to help pay down debt, invest in capital improvements, invest in your employees, and you could be more secure operating going forward because of that. So there's pluses and minuses to each side of it. It's not right for everybody, and not every company should be an ESOP, because like I said before, an ESOP, it's a long-term retirement benefit, so it's got a long-term horizon. If you're in a dying industry or an industry that's a downward trajectory, it might not be the best fit for an ESOP. Okay, next slide. Okay, this is a little bit of valuation overview. 3 valuation approaches should be considered for every valuation. I mean, considered, not used, but considered. It's an asset approach, a market approach, and an income approach. The asset approach should be used when the primary driver or the value of the company is sitting in the assets more so than the income. And you can have this, and I value a company like this where they've come into hard times a little bit, but they're still profitable, but they have a lot of equipment and asset value. So the net asset value of the company is kind of like a floor, where the income approach won't have a value that's higher than the asset approach. So that one's valued by the asset approach. A market approach uses either guideline public company transactions and or guideline public companies that are traded day to day, or transactions that happen to develop pricing multiples that are applied to your company and develop a value using that. Or the income approach is the third one. And this is the approach I think and I believe should be used in almost every valuation. It's my favorite approach, because I think you can adapt it to how you need to for specific facts and circumstances of each client. Because I believe, bottom of my heart, that cash flow is the driver of the value of any company. And even if it's a transaction multiple that you're using, the person that bought that company or whoever bought that company is still looking at bottom line cash flow for just like any other investment, that you're going to invest that's not a company. If you're looking at investing in a bond, you're going to want the bond that gives you the highest cash flow return. Every investment decision, and this is what a business valuation is, it's an investment decision, is about cash flow. So I think the income approach should be used in all of your valuations that you're looking at. The asset and market approach may not apply or make sense in every evaluation. That's just my personal opinion. So I find myself using the income approach most often. Next slide. Okay, if multiple approaches are used, and it's not a bad thing when done right, the approaches should reasonably reconcile. And if you see a valuation that has an asset approach, that the value is down here, the income approach is here, and then the guideline public or market approach is way up here, something's off. Some of the assumptions aren't right, or they're not applying it right, because ideally they should reconcile. Or if the asset approach doesn't make sense, I wouldn't even use it or show it. But if you're using a guideline public company approach and an income approach, they should reconcile. And here's some of the factors I think that might come into play. To me, if I'm doing it, if I'm assuming these guideline public companies are indicative of the market, it makes sense to compare them to your company, then the debt and equity percentage that's used in the weighted average cost of capital for the income approach should be similar, in my mind, to the guideline companies' weighted average cost of capital or debt and equity weightings. Because if they don't, you're saying, okay, this group of companies which has this debt and equity percentage represents the market, and the income approach, we're using a different debt and equity assumption here. To me, that just doesn't make sense, and it doesn't flow. The logic to me doesn't flow between the two, and I would question that. That's something as a trustee, I think that's a reasonable question to have. And that's what I'm saying, because the debt and equity percentages used in the weighted average cost of capital, the income approach are assumed to be at market levels, which the guideline companies presumably represent. So that's just one example where there should be continuity between the methods, and the values between the methods should reconcile, and you should be able to see that in your valuation. Your next question. Next slide, sorry. Okay, here's a quick point. Most ESOPs are valued, and this is the income approach, they're valued under that the most likely purchaser of the ESOP is a C corporation. So that's why if you're 100% owned S corporation ESOP, with great tax benefits, meaning you don't have to pay taxes, you'll still probably be valued with a C corporation taxes factored into value. And that's because anybody that invests in a company is going to consider the tax liability associated with that company, because that's money out of your pocket you can't spend and you can't get as a return on your investment. And if you're an ESOP operating in Pennsylvania, you may want to see if your valuation includes the impact of House Bill 1342. And that became effective in July of 22. What that did is it reduces the Pennsylvania corporate net income tax from 9.99% to 4.99% by 2031. And it represents real tax savings and a possible increase in valuation because of a reduction in the effective C corporation tax rate. I have worked this into all of my companies that work, that are Pennsylvania S corporation ESOPs, because the presumption is that they're still going to operate out of Pennsylvania. In my mind, I think it's a reasonable conclusion, and so I've had the effective tax rate reducing, which is real tax savings and a value added, which you should be, I think, questioning in the valuation if it's not there. Okay, next slide. Okay, here's the ESOP valuation elephant in the room. The Department of Labor updated regulations on valuation. The Secure 2.0 retirement plan legislation enacted in 22 directed the Department of Labor to update the regulations. And the Department of Labor, they needed to provide more guidance on the definition of adequate consideration. And in some of the cases you'll see coming up shortly, that's one of the big issues. They've had a proposed regulation they issued in 1988. It's never updated and finalized. The Department of Labor is in the process of updating the regulations, and they should drop sometime this summer of 2024, and the impact is unknown. However, if you want to look up something interesting, the ESOP Association, they published their own proposal for the regulations, hoping that the Department of Labor might rely on them, and it provides a really good and interesting outline and framework for what they think should be done, and that can help educate you in the process for the valuations then too. Next. Okay. Well, I talked a long time.
I liked it. So polling question number 4, where is your biggest concern related to your ESOP or an ESOP where you are the service provider? Understanding the valuation report, compliance with the plan document, ensuring the participants understand the plan. And Eric, you just made a good point about those DOL guidelines, because that's something that I think is going to be a trend in those couple cases that we're going to be reviewing next.
Yeah, I mean, it was questions, a lot of questions in the cases about what is adequate consideration.
Mm-hmm. Well, and a lot of the reasons why we go through these cases is not because we're obviously not attorneys. One, I think we all find them interesting, but two, like from an audit perspective, if we find something when we're auditing your ESOP, we can help you fix it or set you up with the service provider that can help you. If it gets to the point where it's the Department of Labor or the IRS that find the issue, it's almost too late in that respect, because it's probably going to be a lot more costly to fix it. So we have 17% understanding the valuation report. I think this is 17% because Eric did such a great job explaining it. 35% with compliance with the plan document, and 48% ensuring the participants understand the plan. Okay. So the first case we're going to go through is Scalia versus Wilmington Trust. And this is a bit of an oldie but a goodie. It's from back to 2020. Essentially what happened is the DOL alleged that Wilmington Trust was causing losses to about 21 ESOPs that they were the trustee on by authorizing them to pay more than the fair market value for privately held employer stock. So the DOL, this ended up being settled. Wilmington Trust, interestingly enough, didn't admit or deny any of these allegations. They were basically like, even though it's going to cost us $80 million to settle this, to keep on going in this court case is going to cost any more. Now, the DOL said companies acting on behalf of retirement plan participants must always act in good faith and in the best interest of their employees. When they breach that obligation, they put their employees' financial security in jeopardy and will face legal action. So that's the DOL's case. Wilmington Trust, when they talked about this, they were like, hey, listen, the DOL hasn't issued any guidance to help ESOP trustees for this. So really interested in your take on this, Eric.
Well, this is a gigantic rabbit hole for me that I went down for a couple hours because it's 21 ESOPs and there's a lot of issues in there. You know, bottom line is that some of the valuations and trust companies, you know, may have acted in a manner that didn't let the fiduciaries or the trustees question some things that maybe should have been questioned. They pay. Someone was wrong. So when they pay $80 million back, you know someone did something wrong. But it raised a lot of valuation issues, things about relying on management's projections in the valuation, things that the trustees should have known about, questions, you know, why does this make sense? You know, are these projections reasonable? Push back on things. There's more in there. You know, it's fascinating to go down and read some of these ESOP, but it is like pressure from the companies, from the evaluators for the seller and the trust for the seller to make a transaction happen really quick so that they could do the deal because they wouldn't get paid certain fees that they did. It's just, you read it and you shake your head like, how could this happen and what were things thinking? And some of it is because they didn't have a whole lot of guidance, you know, and, you know, they say they didn't do anything wrong, but their $80 million payment is a lot of money for it. And when you go back into and you look at it, I mean, there's a lot of things that as an evaluator, you should be considering and pushing back on. And that's, you know, I never take management's projections per se without doing look backs and questioning, hey, does this make sense given what I know about the history and where you've been? How are you going to get to where you say you're going to go? And I need to make sure I'm comfortable with the reasonableness of it before I come into value. And that was one of the things that I've seen in a lot of these is that the management projections were really, you know, much higher than history and resulted in values that were a lot higher than what at least the Department of Labor thinks it should have been.
Okay, we can go on to the next case. It's somewhat similar. Again, it's the DOL alleging that a trust company, this time Reliance Trust Company, overpaid when it purchased 100% of the shares of RVR Inc. for $105 million in May 2014. And you may be like, oh, well, Danielle, this is 2014. Why is it relevant today? Well, it was just, the DOL just recovered in 2023, $22.5 million from Reliance. Now, the thing that stood out to me on this case is that they didn't just go after the trust company. There's still claims pending against the fiduciaries of the plan, including the board members. So it wasn't just the trust company that they are suing. They are also going against all of those fiduciary members.
Yeah, there's a lot of interesting stuff in here. And this is the one where they could have sold a 100% ownership stake in it, but then a couple years later, the company this is the one they had warrants and options where they could get back, you know, the owners could repurchase up to 47% of the company at reduced prices. You know, so they had warrants and options. It's just, you know, after everything was said, they paid for 100% control, but they would only have 53% in a couple of years. How that didn't reduce, or the potential for that didn't reduce the value, was beyond me. And that's one of the interesting things about this case, if you go and look at the details of it. And I wish that they would, this is also, they had sealed testimony, so I couldn't read the details or see the details of the report. I had to read between the lines on it.
Well, and I feel like for me, like it wasn't even like years. Like the ESOP bought the shares, and then I think it was literally within 3 months, they could buy back them or buy shares for a fraction of the cost, which how that wasn't a red flag to all of those operating the plan is bizarre to me. And I'm curious, Eric, because the initial valuation from what I was reading was based on a majority ownership, like
100%, yeah.
And if they would have done a valuation based on minority ownership, I assume that would have been lower in theory.
Oh, it would have been a lot lower, yeah.
Yeah.
I don't think they effectively took the dilution impact into it. And that's why there is still a lot of litigation with these outstanding, which may further reduce or increase the recovery from it. But it was, big numbers. Yeah. Next slide.
So I'll go through the next couple, just keeping in mind time, and we want to make sure we get to that last polling question. And if you're interested, like us, in all of these cases, the website where we got a lot of these details are on the slides, which will be sent out after the webinar. So this one is a little bit interesting. It's more of a compliance and a fraud case, where in this one, the DOL had a fiduciary removed from the ESOP because he took $300,000 from the funds and moved them to cover business expenses. He also didn't pay a $30,000 distribution when a participant requested it. So a lot going wrong on this one, and a good case for you to ensure that you have a committee with governance over the plan that isn't just one person like the CEO, which is probably why this was made possible. So we can go to the next slide. Again, this one is a really interesting case, so I do recommend that you look into it. But essentially, 80/20 was a company that was founded a few years ago with a dad and his 3 sons. And then they did an ESOP in 2016. And at that point, the dad went ahead and put in his will that when he passes away, he would like the interest in his shares to go to the ESOP, although it could go to a third party if it's not possible for the ESOP. So the participants weren't happy when they found out that the shares were all going to be sold to a private equity, which Eric kind of started to talk about this, and then the ESOP was terminated. So this one is a case where it's not the DOL, but the ESOP participants that are suing the former chairman. Okay, next slide. This one we won't get into. This is one just to keep in mind. They talked about this, I think, at every single conference that we went to this year. So if you have a chance to look it up, it's still very much in flux, but it probably will have some ramifications for plan sponsors when making decisions on whether or not to re-leverage your ESOP. So next slide. Okay, last polling question. Do you wish to receive SHRM credit for attending today's webinar? Yes or no?
And while you're looking at that, just encourage you that if you have questions or thoughts after looking at this that we haven't answered, our contact information is going to be coming up on the next couple of slides. I love hearing from people and getting into discussions about this, and I know that Shalane and Danielle do too. Please don't hesitate to give us a call, contact us. If we can answer questions, it's just part of the relationship that we like to build.
And a recording of today's presentation will be posted on our website and social media sites in the next few days. And for those of you who did request CPE or SHRM credits, as I mentioned earlier, you can expect your certificates to be mailed out to you in the next few weeks. And there is our contact information.
We have 1 minute left for questions. We're upcoming events. You timed it well.
Please feel free to register for our next few upcoming events. That they are an affordable housing webinar series. The first one is July 18th, low income housing tax credits. And then that's it. Thanks again for joining us today. And like Eric said, if you have any questions or concerns, please reach out.
Thank you.